All right, today I'm going to go through an investment philosophy, and it is the intrinsic value investment philosophy. I have an example I'm going to go through. As you know, I think that examples are probably the easiest way to learn, but before we do that, let's just talk a little bit about it. What is it? It's the return of the expected growth rate of intrinsic value and then the price conversion. What does that mean? First off, the growth of intrinsic value, what is that? That's what the company is doing itself. You own a stock. That's a stock of a company. The value of that company is appreciating by all the financials, everything that's going on at that company, its peers, everything else. That's what sets what would be a fair price to buy that company at. The price and the conversion of the price to its intrinsic value is why you have stock that's so volatile. Sometimes stock is way up, sometimes stock is way down. It's just because it gets a little out of whack with its true intrinsic value. So let's just say that the price is super high compared to what the company probably should be priced at. Then it converts down, that actually takes away from return. And that's what I'm going to show you in this example. So let's look at this. I want to set a 5-year example, and I do have, there's not exactly like this, but there's a nice case in the CFA Level 3 curriculum in the capital markets expectations. And what capital markets expectations are is you're just trying to determine, where should I invest? Should I invest in bonds? Should I invest in stocks? And I kind of get to that at the end of the case. But let's just say you start off, look 5 years back, and in the investment it was $325, but the intrinsic value was $357. So when you have a price of a company that's lower than what's value is, theoretically you should be able to get the return on the intrinsic value from the company growth and also get the difference in price. So that's why I went from $325 to $400 to $450, and right around there, and this is just a fictional stock, it doesn't make sense, but say this happened, now you're over its intrinsic value. And let's just say this persists for the next 5 years. And at the end of the 5 years, your price, the stock price is $675, but the company is only $525. Now the company did grow a lot. The company grew from $357 to $525. It just didn't grow as much as what the stock price is. So now we would need to understand, well, what should we do? Should we still be holding 100% of the stock? Should we be holding maybe a bond instead? So let's look at what the expected return is. First, figure out a timeline. This is where the CFA example says you got to figure out a timeline to use, and we're going to use 5 years as a timeline. It's very, very difficult to know when and how intrinsic value is going to convert. Nobody knows when it's going to convert. It's kind of opposite. It's easier to understand the company's financials in the short run, harder in the long run, whereas the price, very, very hard in the short run, but easier to project in the long run. So let's just say that the company is growing at 8%, and we're trying to determine, should we own a company or a bond? And the bond's growth is at 4%. We know that the company itself is growing at 8%, but we also are saying in 5 years, it's probably going to convert back to its intrinsic value. So what you have to do is you take this 525, you look forward 5 years at 8%, that 525 true value is 770. I have now 675. I could take some gain from my stock at the price point of 675. And if I'm going to get 4% of my bond in 5 years, that 675 is going to be worth 820. So in this particular case, if you're forecasting expected return, the bond is more favorable in the stock with using a 5-year time period, simply because it took 5 years to convert back to its intrinsic value. Now, in the case of the CFA, they gave a real life case where the person made the projection, and actually in their projection in real life, it converted way faster. So say for instance, if the stock in 1 year converts from 675 back to 525, then of course the bond is going to be way better because the stock is actually going to produce quite a big loss, which that's what happens in the stock market. So this is a strategy that is still a long-term strategy because you don't know what's going to happen with the ups and downs. This is how to do it if you're trying to forecast a stock and a bond and you're using the intrinsic value philosophy.